So my newsletter this week was honestly pretty similar to last week. Obviously, some things have changed, but just similar topics at least. So I mean, obviously, this week we've seen pretty strong price action from the equity markets, despite some pretty bearish macro indicators, which is super interesting, and it's kind of something that I've discussed in the newsletter. I don't know, probably 5 times now over the last couple months. And that's just that the bond and equity markets are forward-looking pricing mechanisms. So I talked about this last week, but it's the markets take in information as it comes in, and so they price that information in, and they're forward-looking. So due to that fact, these markets will bottom before the macro situation sorts itself out. I'm not necessarily saying that the bottom is in, while of course it could be. But it's significantly more likely that this bounce is simply short covering, a counter trend rally rather than being a true, bottom in the bear market. And that's an old quote. It's just that stocks follow the path of least resistance. So when the overall trend is down, the likelihood of that trend breaking is very low. And of course, this could be the bottom, right? But statistically speaking, the chances of it being the bottom are very low. But you'll always see numerous rallies, significant rallies during a bear market, and that's shorts protecting their gains by buying shares, and long traders trying to jump back in and buy the dip. And bulls like to assume that the decline's over, but the reality is that the majority of the time it's simply a short counter trend rally that generally punishes lack of patience if you aren't too careful. And also there's a thread up at the top of some of the charts I'm going to discuss today. So if you're looking for a visual as well, you can go click on there. So this first one I want to discuss is this. It's an orange looking chart, and that tells us the total amount of shares that were sold short on the NASDAQ ETF QQQ. So what's interesting to me there is if we look at July 5th, that's when the ETF was up about 1.7%. And we saw this strong uptick in short sales. So that's like, the opposite of buy the dip. It's, short the rip. But the issue is, when that trend or that, rally keeps going, the short interest starts to decline because we're, squeezing shorts and they have to buy shares to cover. So, you could say that a significant portion of this rally, could be due to that piece, this short squeeze, if you will. But there are also, some dynamic and horizontal resistance levels that I'm looking at for QQQ that I'd like to see them surpass to prove that buyers are in control. And looking at the market right now, it kind of looks like we're bounced off one of those. So I think for the remainder of the session, it'll be interesting to see how that plays out. And as I mentioned, it's certainly possible that this is the bottom, right? Nobody knows. Anyone who tries to tell you they know is being disingenuous, but the worst news generally tends to arrive right at the bottom of decline, right? If you think of 2020 when they were locking down everyone and, it was the most uncertainty and the most, scary news stories that came right at the bottom of the bear market. So I think it's certainly possible that, there was headlines everywhere last week. Oh, worst first half of a year since 1970. And I wrote about it in the newsletter too. And it's certainly possible that was the news cycle that we needed to inject enough fear into the market to bottom. But of course I don't know. But there's there's a few indicators that might lead you to believe that this isn't the bottom. And the one that stands out to me the most is looking at market breadth. So when we look at that, and market breadth is just examining how many names are participating in a given market move. So when we look at market breadth now, what we see is that this rally is only being, participated in by only a few names. So the market doesn't have that, strong foundation in terms of, numerous names and numerous industry groups rallying alongside with it. So if we look at in that thread, there's a chart of QQQ. At the bottom, there's a blue line, and that line is known as the advanced decline line. And that measures in total how many names are advancing versus declining. So when that line is, increasing in value or sloping higher, we know that more and more names are joining the rally. And what what you can see this week is that the line was sloped slightly higher on Thursday yesterday, but there hasn't been a significant amount of names advancing. In fact, the line is essentially sideways on the week, which tells us as the index is increasing in price. Not a significant amount of new names are participating in the rally. So for a prolonged rally, what you'd like to see is breadth expanding or increasing as the index advances in price. As more and more names start to join the rally, which provides a strong foundation for the index. So I kind of like to think about market breadth as the foundation for what the market stands on, because you want numerous names participating, so there's not one point of weakness, right? If you have really weak breadth and maybe it's just some of those big FANG stocks that are propping up the index. If those stocks go to get hit, then there's no foundation in the form of numerous names participating. So looking at the advanced decline line, like that's in that chart that I've shared, it doesn't really appear to be the case that there's a lot of names participating in the rally. I've also plotted on that chart. It's kind of there's a lot going on there, and I apologize for it, but I think it's all important. There's a bunch of trend lines and moving averages on there. They're kind of showing us different, dynamic and horizontal support levels that we could see, the NASDAQ run into or fall back on. So there, I drew two parallel lines that kind of show us this channel that the NASDAQ's been trading in, which to me looks like a bear flag. But of course, anything's possible. I said that about MicroStrategy last week, and it broke out from that bear flag. So, who knows? Anything's possible, but it's certainly something of note. On Thursday, also, QQQ cleared above this pretty long 3-month trend line that was had already turned into resistance twice before. So that's significant to note. And we were also able to get above the 10-day and the 21-day EMAs by a fair margin. And then, I said that, Friday, so today and the next few sessions would be, key days for the Qs, because we'd likely run into the 50-day and this horizontal resistance level that dates back to the October 2020 correction, which was around 298. And that's right about where we, hit earlier today. And we've sort of declined since then. So that was something to note, and keep your eye on even for the rest of the session. We're bounced basically right off that 50-day moving average, which is just, I like to call it the guardrail. I think it's the most important moving average that a lot of institutional investors use. So it's definitely something to keep an eye on. But I also mentioned price action matters more than any indicator, right? I always say price is king. Price is the only thing that pays. So what price is telling us is that at least in the short term this week, that the bulls have the reins, right? We're seeing price increase every single day. But what we need to do is we really need to see the indexes make higher highs, which they've pretty much been completely unable to do since we topped in November. So for the NASDAQ, we'd like to see it take about 11,700 and then 12,300. For the S&P, it'd be about 4,000 and then 4,200. So moving on from the equity markets, I want to talk a little bit about the fixed income markets. So we started to see yields rise again this week, following the last 3 weeks of bond buying we saw. So keep in mind, if you're not, super familiar with bonds, it's prices and yields move in an inverse. So when I say yields are rising, that means bonds are selling off, which can be a little confusing at first. But what we saw this week is that the 10-year ran back into sellers as yields touched 2.75%, which was pretty close to where we saw the bond market. This is pretty close to where we saw the bond market, get some support in terms of yields in the May rally as well. So I talked about it last week in that the rally in the bond market was probable or maybe likely to spill over into the equity markets, which is what we saw this week. So now as the bond market sells off, the question is that going to spill now back over in the equity markets later? And I think it's possible, if not probable, but it's pretty early to say. And you can't even necessarily say if the rally in the fixed income markets is even over. Yields are up about 0.2% or so from Tuesday, but they're still 0.5% from their previous highs. So I think it's a little early to even say if that rally's over. Going further into the fixed income markets, we saw the spread between the 10-year and the 2-year bonds flipped negative this week for the second time this year, which was a pretty big, news event, I would say. And if you don't understand, yield curve spreads, essentially it's just giving us an idea of economic health, because we can look at the expectations of market participants. So when there's a high spread between a short-term and a long-term bond, it means that investors are confident in the short term because that price for the shorter term bond is higher than the longer term. But when that spread's falling, it tells us that people are becoming increasingly nervous about economic conditions, at least in the short term. More so compared to the long term. And then on occasion, you can see that spread fall below zero, meaning that the yield of the short term bond is greater than the long term, which is a signal of yield curve inversion. And there's a bunch of impacts of yield curve inversion. I'm not going to get into them here. I would recommend going to read the newsletter. And I've also included a chart of that 2 to 10 year spread. And what you can see is that it's a strong indication of incoming recession. And every time that the 2 to 10 year spread is crossed below zero, it has signaled a recession within 2 years. And the key word there is within 2 years, right? It does not mean that there's going to be a recession tomorrow or that we're already in one. But it has been a good signal in the past of an incoming recession. And of course, the reasons for that are included in the newsletter. So you guys are going to have to go check that out. I've also included in the newsletter a Excel sheet that breaks down the last 5 yield curve inversions going back to 1989. And what you can see is that the average time it takes from inversion to recession is 43 weeks. So almost 11 months. So, once again, that isn't, just because the 2 to 10 year spread flipped negative, doesn't mean we're in a recession. You shouldn't be panicking because of that. But it is a relatively good signal of something coming in the future. And like I said, it doesn't have immediate effects. So, while it can be dangerous, the amount of time that you spend with that inverted spread is much more important. And that's why you generally don't see recession for at least a few quarters. So just because we just flip negative, doesn't mean something's coming tomorrow. We need significant time with a negative spread, which we haven't had yet. So, even if the Atlanta Fed is predicting 2 consecutive quarters of negative GDP growth, it doesn't necessarily mean that recession is looming just because the yield 2 to 10 year spread went negative. So I also broke down as a follow up to last week the Atlanta Fed's GDP Now estimates. And last week when I wrote about them, their estimate was down to minus 1%. And then as of today, or as of yesterday, I should say, it was back up to negative 1.9%. So 2 consecutive quarters of negative GDP growth is a sign of a technical recession, but it does not put the U.S. in an official recession. And there's a pretty big difference between the two. And that difference is that a legitimate recession, an official recession, which is declared by NBER, has to affect numerous sectors of the economy and not just GDP, which is an aggregate estimate of output. So a technical recession is not a good sign, obviously, and it generally does lead to a full recession. But a true recession, a full recession, has much larger negative effects on average Americans than just a technical one. So, and of course, I talked about this last week in the newsletter. So, if you want to read even more about what it takes for NPER to declare a true recession, I would go back and read last week's newsletter. I also talked about initial jobless claims in this newsletter. So, if you go to my thread there, you can see some of these charts I'm discussing. But I included a plot of initial jobless claims from 1967 to 2020. And it highlights the recessions also there in gray. And what you can see is it takes a substantial and prolonged increase in unemployment before that recession generally truly sets in. And then if you compare that to a chart of 2020 to 2022, what you'll see is that we are beginning to see an uptick in people applying for unemployment benefits, which is what initial jobless claims are. But that increase in claims is still pretty small. The most recent data point, which was released on July 2nd, showed 235,000 claims, in comparison to 240,000 in January. So, there has been sort of this rounding out of that, data point, but it's not it's nothing significant yet. And if you compare it to that historical chart, you'll see that we aren't even close to that level where you start to see them declaring a actual recession. But unemployment is one of those key factors that we look at to determine whether or not we are in a recession. But I kind of mentioned, people right now may be hurt by higher fuel prices and food prices and the rising interest payments. But in a true recession, that true pain will set in once there's other things like mass layoffs and bank runs and crashing asset prices, and we're not there yet. And then, of course, I also talk about crypto exposed equities in this newsletter. So I did a follow-up on Microstrategy from last week because I think from a technical perspective, Microstrategy has been the strongest performer, or one of. It's up, it was up 16.5% yesterday. I also mentioned a few of the other names that have stood out to me from a technical perspective. And then, of course, as always, I include a table with about 25 or so crypto exposed equities, and then we compare their weekly performance Monday through Thursday, or I guess Tuesday through Thursday this week, in comparison to Bitcoin and WGMI, the Bitcoin mining ETF. But that is a rundown of what I wrote about. Of course, there is more in the newsletter, and there's some things that I left out. So when we release that, I highly recommend going and checking it out.
People talk about they're waiting for the Fed to reverse course. Would you think that's not going to happen until we see a big spike in the unemployment claims?
I mean, not necessarily. I think, everyone, a lot of people like to talk about, and I've discussed it previously as well. And I was talking to Caleb Franzen, who some of you guys might follow, and he was kind of saying, he kind of helped to change my mind, or I guess give me a different perspective, in that we always look at this chart of recessions and the Fed funds rate. So what you see is there's this trend line that slopes down, that every time the Fed funds rate hits a certain level, it causes recession. And I think, so that's kind of the argument that, hey, the Fed's going to have to reverse course, maybe in the next few months, because we're going to reach this level where there's so much insolvency that it could cause recession. And I think what's not accounted for as much, and I think is super important, is the time you spent at a certain interest rate. So companies and people, you can eat a higher interest payment for a period of time, right? If you wake up tomorrow and your interest payments increased, it hurts, of course, but you can survive. So once you get 6-8 months of that interest payment, obviously then you get to have solvency issues. That's when you start to see those issues. But I think the time you spent at a certain interest rate is super important and underappreciated. So I do think the Fed going to have to reverse course earlier than they've been claiming. I think people don't give enough credit to the time you need to spend at a certain interest rate before you start to run into solvency issues. I'm not sure if that answered your question or not, though.
No, that was great. Joe or Will, you guys got any comments on macro before we move on?
I think that was a great point about time and interest rates. I've always thought of interest rates as if gravity on financial assets. And so gravity, gravity on Earth, 9.8 meters per second squared. So like Blake said, gravity actually takes time to have any effect on the economy or, mass moving in space.
I like that. That's a good analogy.
Sounding like Sailor whipping out the engineering terms, like gravity. All right, we can move on to, I've got a flow chart up there talking about Three Arrows Capital. And I'm sure a lot of you, there's a lot of players involved in this situation. So this is just going to be a really high level overview. And in the newsletter, all the sources are there for everything. So Voyager has declared bankruptcy, and they lent out money to 3AC and to Genesis, who lent money to 3AC. And basically, Terra Luna was the first domino in this. Three Arrows Capital had a big position in Terra Luna and also Grayscale Bitcoin. BlockFi, as you all know, they're in some trouble. They lent 3AC $1 billion, and 2/3 of that was in Bitcoin. So when they collected that collateral, they liquidated that but they also had 1/3 of the 1 billion was in grayscale Bitcoin, and that's not nearly as liquid as real Bitcoin. As Will's mentioned before in the newsletter, like Bitcoin and ETH, they tend to get liquidated first because they are the most liquid assets in this ecosystem. So BlockFi and Voyager, they're down bad. We haven't seen anything yet from Gemini, but on their website for the Gemini Earn program, they listed Genesis Capital as one of their borrowers, basically their only borrower, and Genesis made a big loan to 3AC, so we could see more liquidations from possibly Gemini. They could go down. Celsius yesterday, legal action was taken against them by a former employee. Basically, they were running a Ponzi scheme. They were using new members to pay off the interest earned from old members. So that wasn't good, and they were in debt to Maker, Compound, and Aave. Basically, the long story short with this is like, if Canada didn't tell you need to hold your own keys, this situation definitely tells you why you need to hold your own keys. Because any of these platforms, even if you're not on an interest-bearing account, all of their terms of service says that you are an unsecured creditor. You don't actually own anything on there. They control the assets, and they have no liability to return them to you. So you just really need to take self-custody. Like, even the biggest exchanges, Coinbase, like BlockFi, all of them, like their terms of service, you do not own Bitcoin on there. Joe did an interview with Unchained Capital this week. If you guys want to go check that out, they offer multi-sig solutions. So you hold 2 keys, they hold 1. It's a pretty good setup. So that's basically the TLDR. Like, all of this is causing. Obviously, it's going to bleed into the Bitcoin economy because they need to liquidate their Bitcoin. So Saylor says it a lot, but regulation could be good because we need to regulate all this crypto nonsense, because unless this happens, like, this is going to keep bringing a bad name to Bitcoin. So regulation should be coming soon, and hopefully that can clear up some of this garbage.
Hey, Mitch or Joe or someone that could talk about it. I think maybe explaining what MultiStig actually is, and and what the benefits are. I think could be beneficial for people, because that was something that I didn't fully understand, and then once you get it, I think it's super cool.
Yeah, I'll take it. It's basically, there's 2 of 3 or 3 of 5, and instead of just having one key that controls your Bitcoin, you have multiple. So if you have 2 of 3, you need 2 keys to move the Bitcoin. It's really good for institutions, right? I'm sure MicroStrategy uses MultiStig, because you can basically have, like, Saylor might have a key, his accountant might have a key, maybe his mom, and then maybe like a third party has a key. It's good because, like, if Michael Saylor had just one key for all their Bitcoin and he got in a plane accident, God forbid, or something like that, then it'd be a tough situation. So it's good for its security, as well as passing on Bitcoin for, like, inheritance reasons. So maybe if you're married, you have a key, your spouse has a key, and a service like Unchained has a key. So it's better than having one key, because it's more secure and it's more, like, transferable. Obviously, you don't want to trust anybody, but you do want to trust somebody. Like, if you don't have anybody you can trust with one key that's in your life, then that's probably not a good situation.
Yeah, that was a great explanation. I think another way to put it too is, not only is it more secure, but it's more redundant. Like Mitch was saying, like, you can do a 2 of 3 or you can do a 3 of 5. And if you lose one of the keys, or you can't find it, or Harper Wallet gets destroyed, or your seed phrase was backed up incorrectly, you're still good. You still have access to your Bitcoin. So you kind of have that extra layer of security by requiring 2 keys to unlock your Bitcoin, but then you have that extra layer of redundance to make sure, hey, I can mess up part of this and still have my Bitcoins as well.
Exactly. Joe, you want to go ahead and talk about hash ribbons and mining?
Yeah, sure. I can cover mining real quick, and then after I do this, we can pass it off to Will to do on-chain derivatives and anything else Bitcoin related. But yeah, for mining this week, current 14-day moving average of hash rate is about 209 exahash. Hash price, which is the dollars you earn per terahash per day. Hash price is sitting at around 10 cents. The previous difficulty adjustment that the Bitcoin network had earlier this week was down, so good for any of the existing miners. All of the existing miners are earning slightly more Bitcoin. It was down 1.4%. Currently, most projections for the upcoming difficulty adjustment are positive, but it's still early to tell. Blocks are coming in fast, but there just hasn't been enough sample size to really determine exactly how the magnitude of this upcoming difficulty adjustment and whether it's going to be positive or negative again. But as mentioned in previous, Blockware Intelligence newsletters, hash ribbons, which is a chart at the top of this space, basically is a great metric to indicate whether miner capitulations, that means our miners on net turning off machines, it's used to determine whether these capitulations are occurring. So you can see in the chart that this has actually been going on for 31 days now. And actually, at the start of July, it looked like there was potential for the capitulation to be close to ending. But recently, the hash rate kind of diverged again. And it's kind of uncertain as to when this minor capitulation will end. But historically, and I'll talk about this in a sec, when capitulations end, that's normally a great time to get long Bitcoin. Also, in the newsletter this week, you'll be able to see an estimated miner break even table and chart. This will break down miners from old gen, mid gen, new gen, and what electricity rate those different segments of miners are operating at. So a lot of this data was compiled from public miner and investor relation resources, CoinShares research, and old Blockware research. And this isn't, an exact science at all. It's kind of impossible to perfectly piece together the entire Bitcoin mining network. And that's kind of a feature, not a bug, but it is kind of an interesting thought experiment to go through and see, hey, where will the network start turning off if price goes below $10,000, what percentage of the network might be operating unprofitably. Now, also, it doesn't necessarily mean if Bitcoin just drops to $10,000 tomorrow, doesn't necessarily mean hash rate is going to just fall off a cliff. Because, a lot of these miners have power purchase agreements, they have hosting contracts, they basically, can withstand, depending on how deep their Bitcoin treasury is, how much access they have to debt or equity raising. They don't necessarily have to turn off their rigs right away. But if the price stays below a certain level for a certain amount of time, it makes sense for miners to start turning off machines and trying to sell them, and also trying to just dump their Bitcoin treasuries. So hash ribbons, very interesting metric. It's like the main thing that I'm monitoring from Bitcoin mining perspective right now, and we're right in the midst of this minor capitulation. The last 4 major minor capitulations are very interesting. I think they're very relevant to kind of understanding what's going on right now. The first one was back in the 2018-2019 bear market, when Bitcoin just dropped from 6K to 3K, and I think that's kind of a very relevant comparison to what's happening today. Bitcoin has fallen from 40, 30K all the way down to 20K. Price is kind of stabilized here, over the last couple weeks, similar to what happened in 2018. And, hash rate is kind of starting to recover, but, we'll see if price goes lower and brings more machines off the network. The other second major minor capitulation that we've had historically was the May 2020 halving, or it was actually March 2020, the price crash when Bitcoin fell 50% in one day. The weeks after that, hash rate dropped significantly, and we experienced another minor capitulation. After that, the third most significant minor capitulation that has occurred recently was the May 2020 Bitcoin halving. This was when the block subsidy got cut in half from 12.5 Bitcoin per block to 6.25. Obviously, this is going to, as you know, we've seen in the past, weed out the weak miners, and the weak miners are going to be forced to turn off their machines. And last, the fourth most major miner capitulation that was kind of unrelated to price or revenue that miners were receiving was obviously the China mining ban. That was like the largest percentage drop hash rate we've seen, and magnitude as well. Many machines were turned off, and once that ended, you know, we ran for pretty much the rest of 2021 up until like near the end of November when Bitcoin hit almost 70,000. So like the key takeaway, I guess, from all of this minor capitulation talk is that during minor capitulations, miners are very pro-cyclical, so they're selling a lot of Bitcoin, they're selling their Bitcoin treasuries, they're selling their mining rigs. But after these minor capitulations, those weak miners that may not have made it through the tough times, they are purged from the network, and they no longer have to sell those Bitcoin that they mine because they're no longer mining. And the day-to-day sell pressure moving forward is much smaller compared to what it was before the minor capitulation. So I think it's kind of a healthy process that we're going through right now. It's cleaning out the weak hands and the weak miners. And, you know, once we go through this, Bitcoin and the entire network will be better off.
It's just the self-correcting free market at its finest when you think about it. These capitulation events really highlight how Bitcoin mining is just a purely competitive industry. When you say weak miners, you know, it's people who either bought poor machines or they didn't get set up right with their power cost structure. And now the ones who have done really well, they're going to reap the benefits of that. With the difficulty adjustment, it self-corrects, and the best performers are going to win. Then you have the outside events like the China mining ban, and that just creates the whole game theory element. Like, okay, China can ban miners, but the hash rate's going to come back online somewhere else. It's more accepting. So mining really is just a pinnacle of free market competition. If on that note, if anyone is looking to get into mining, send this Blockware account a DM, because we do offer mining solutions and hosting solutions.
Cool. Yeah. Will, you want to take over?
Sure. Yeah. No. Thanks, guys. That was great. My section is going to be relatively short this week, just at least in the Twitter space. Like I mentioned, I haven't put my section in the newsletter yet this week. Yeah. I mean, just kind of to go off of everything that Joe said from a mining perspective. Another thing that I've been looking at is something called the Quell multiple. The Quell multiple looks at essentially the USD value of daily issuance relative to the 365-day trend. And so it's somewhat of a gauge for essentially miner profitability. And what you see is historically, whenever this value kind of dips down into this area, it's been a great time to average into BTC, because that's marking that kind of miner capitulation dynamic that Joe described. You know, as we've been talking about for a while, you know, all these things that Joe just mentioned, you know, hash price at its lowest since the end of 2020. You know, hash rate starting to decline. You see hash ribbons crossing over, some coins coming into exchanges, all these types of things. You know, it really just goes to show you how much of a, you know, pro-cyclical force that Bitcoin miners are, holding their Bitcoin in the bull market, and therefore taking off natural sell pressure from the market, and then in the bear becoming forced sellers, and in some cases like 2018, arguably marking kind of the capitulation bottom at the end of the bear market. So yeah, no, that's great. Other things, you know, one thing I'm watching for kind of you know, I guess you kind of say the intermediate term, is the 200-week moving average. I think this is something, you know, some people say it's a meme. I think, you know, something that all market participants are watching. Historically, the 200-week moving average has marked the kind of cyclical bottom for BTC. You've never seen a weekly close below that. Recently, we have kind of just sliced through it like butter. And on this move over the last day or two, what I posted yesterday and what I'm watching is the reaction there. I do think if we were to see a weekly close back above that 200-week moving average, that would be a good kind of play for continuation, because essentially it would make everything below that close like a deviation below. So that would be a decent setup from again, I've talked about how I'm not really doing any short-term trading in this environment, but I do think that would be a trigger for a lot of swing traders, as well as probably set off some algos as well. So I'm kind of watching that in the shorter intermediate term. And I do, obviously, like if we reject off the 200-week, that'd be a great sign. But I do think closing above that on a weekly would be a good sign for continuation. From like a derivatives perspective, I posted this yesterday. I said, ultimately reversal will likely be signaled by spot bidding into disbelief from derivatives. So what I mean by that is essentially when you have an underlying, spot bid with derivatives kind of shorting into that, or not kind of going with the direction of what spot's doing, that kind of leads to these massive moves in either direction. I mean, you could have the opposite as well if derivatives are longing and spot is dumping on them. Two examples of this, I think the biggest, at least from my perspective, was the end of last summer. We talked really heavily about kind of the setup where you had this prolonged regime of negative funding, and you had an underlying, what appeared to be an underlying spot bid that ended in that massive short squeeze off the lows at the end of summer. I think looking at funding, which I guess I could talk about what funding is real quick. So there's this thread at the top of my profile. It says explanation of perpetual swaps. I talk about this in there, but just from a high level, funding is based on the delta between spot and the perpetual swaps. It's the price that is essentially paid. It's the funding rate, as it is in the name, between longs and shorts to kind of tether that perp price to the spot index price, which is like a weighted average of all the spot venues. And so, therefore, it's kind of a good indication of positioning from derivatives. I think funding rates are useful in two ways. One would be kind of a divergence between the two. So if you see price rising, funding dropping, or price dropping and funding rising, that kind of indicates to me that some of these derivatives traders are starting to get off sides. The other would be a prolonged regime of one or the other. So if you're seeing a prolonged regime of positive funding, an example of this would be at the beginning of 2021, or a prolonged regime of negative funding, for example, would be the summer of last year. And so, when I talked about in this post, I said, here's our checklist for what we want to watch. We want to see a prolonged regime of negative funding, ideally funding increasingly negative as price is rising. So that'd be one thing. The other we want to see is rising open interest. And open interest is just telling you the number of contracts. There's a long for every short, so it doesn't tell you, the positioning of those contracts. You could look at, where open interest is coming in and try to say, okay, it looks like open interest is rising on, moves down, and, it's getting wiped out on any poke up. That probably means that it's a bit more short biased. But, in essence, open interest just tells you how many contracts are open. So we want to see rising open interest in both absolute terms, so just in the raw dollar value, as well as relative to market cap. So one thing I like to look at is open interest relative to the size of Bitcoin's market cap, because of course, you could have $50 billion open interest at a $25 billion market cap for Bitcoin, which is a lot different than saying $50 billion of open interest relative to a $10 billion market cap for Bitcoin. So I kind of think of open interest as kind of the fuel that can be laid out for a potential move. And then you look at funding as kind of a gauge for the positioning of that fuel that's laid out. The last thing I would say is looking for quarterly backwardation. So quarterlies are when I'm talking about that, I'm talking about the 3-month futures. Historically, whenever those what's essentially the futures curve, so the slope out, positive slope is contango, negative slope is backwardation. Whenever that slope gets into backwardation, that's historically signaled a great time to buy as well. So we have, out of all that checklist, we have seen quarterlies go into backwardation. We saw that briefly on a couple venues like FTX, OKX, and Deribit. Those kind of brief pushes down looks like it's potentially like some individuals that blew out on that move down to like 17, 18K. But nonetheless, I do think it's enough, especially seeing it across multiple venues, to kind of check that off the checklist. We do still want to see the other two things we mentioned about open interest and funding to feel confident in some type of reversal. Again, the ideal scenario here would be you see, open interest rising, and this is basically exactly what happened last summer. Open interest starting to rise, price starting to grind up, and, a negative regime of funding throughout that entire time period. And then as price starts to grind up, you see that the funding continue to go more negative. I mean, that's kind of the clearest cut, example of what you would want to see for bulls, at least. Moving on from that, I think another interesting thing to talk about, Joe, was talking about like capitulation stuff. You'd mentioned some of the stuff around miners. Another thing that we talked about last week, which we were watching, was the correlation between Bitcoin and ETH and the rest of crypto. So one metric that I looked at last week in the newsletter was comparing the market cap of Bitcoin and adding to that the market cap of Ethereum, and then subtracting. And running a correlation of that of Bitcoin and ETH, subtracting out the rest of the crypto market. So essentially, you get Bitcoin and ETH, the correlation of that to the rest of the market. And the reason why I do that is because Bitcoin and ETH are the two most liquid products in the crypto market, obviously. And so seeing a decline in that correlation to me indicates that you're seeing some type of forced selling from just the two largest, most liquid assets of what people have to sell and not necessarily what they would like to sell. A lot of these altcoins just don't have any liquidity at the moment. So seeing over the last week that correlation coming back up, to me indicates that at least in the kind of the short term, we've seen some of that forced selling pull back a bit. So I know that was relatively short. A lot of the valuation metric stuff that we've talked about for like a month or so, those things will all be in there as well. Those stable coins relative to crypto market, indicating that dry powder is fine. That's still at the same territory we talked about last week. I know it's relatively short, but I think that kind of covers from a high level most of the talking points.
Will, I had a quick question. So, given that Bitcoin just had its like pretty much worst quarter ever from what I remember, and funds like 3AC are blowing up, issues with Celsius, BlockFi, Voyager. Why do you think we haven't seen this like prolonged regime of negative funding yet?
Yeah, I'm not sure. I mean, it's something that like we've started to see a little bit. But I mean, like over the last few days, for example, you've seen funding go positive like pretty strongly on this push up. I think like what from like a psychological perspective, what happens is over the long, like you need a long enough regime of basically training traders, minds to behave a certain way. So, for example, like at the beginning of 2021, traders were rewarded very greatly for just aping in leverage longing every single dip, and so like after several months of that happening, you're basically conditioning the market to think a certain way, and then conversely in summer of 2021 they're getting rewarded for fading every single move up to 35 40K, and so the back half of summer, once you finally had that underlying aggressive spot bid, you had the deviation below 30K, all that good stuff. They were conditioned to do what they had been doing for the last few months. And so like it's almost like you need to, from a psychological perspective, you need to train the market participant's mind to behave a certain way for long enough that they act as if they have over the last few months, and that allows a new kind of regime change. Like the regime change comes when the underlying structure is shifting, but the basket of market participants continues behaving as they have in recent times. So maybe perhaps we haven't seen that depth of like psychological reinforcement that we need to see to get people to, because obviously what you want to see is that, you know, funding again going negative as prices rising, which hasn't been the case over the last few days. But that you know, from a derivatives perspective, that's what you really want to see to kind of feel confident in a full on like trend reversal type of thing. Hope some of that made sense. I guess, you know, the answer is potentially just, you know, more time. I think kind of my base case is, you know, again, we could see some mean reversion here in the short term, but I think when you talk about like what happens over the next few months, kind of my base case is that we chop around in kind of some type of accumulation range. You know, when you look at, you know, all these metrics being in kind of these accumulation areas, you know, although perhaps, you know, they're around areas which historically have kind of marked, you know, the bottom. I mean, you can see capitulation through price and then capitulation through time. And I think perhaps we've seen the former and now we're just going to see the latter. And then I guess another piece of data to back that up as well would be Q3 historically has been the worst performing quarter for Bitcoin. Historically, every quarter on average has been positive because Bitcoin's like up only over the long term, as everyone knows. But essentially, to me, what that indicates is like the price has been relatively, you know, just flat, right? And so I think that kind of adds to that thesis as well. So yeah, I mean, I think Q3 base case is probably just sideways chop.
Yeah, I think that was really great. Thanks, Will.
If anybody joined late, this will be up on YouTube today or tomorrow, and the newsletter should be out pretty soon later today, so you can read through all of this, look at all the charts and everything. Any of y'all have any more comments before we wrap up?
Nothing from me. Enjoyed it, guys.
Yeah, nothing for me. Be sure to check out the newsletter. Yeah, like Mitch said, it'll be recorded on YouTube. Hope everyone has a great weekend, but that's all I got.
Thanks, gents.
See you guys.